Hey everyone, welcome back to the channel. Today we're diving into a topic that often confuses both new and experienced traders, the difference between margin trading and leverage. These concepts are key to understanding how you can maximize your profits in the world of crypto and stocks, but they also come with significant risks. By the end of this video, you'll have a clear grasp of what margin trading and leverage actually mean, how they work, and how you can use them safely. Let's get started and break down these important trading tools together. Let's begin with margin trading. Imagine you want to trade a larger position than your current account balance allows. Margin trading lets you borrow money from a broker or exchange to do just that. For example, if you have $1,000 in your account but want to trade $5,000 worth of Bitcoin, you can borrow the extra $4,000 from the exchange. This borrowed money is called the margin. However, you must always keep a minimum balance known as the maintenance margin to avoid having your position liquidated. Margin trading can boost your buying power, but it also increases your risk. Make it clearer, let's walk through a simple example. Suppose you have $1,000 in your trading account. You want to buy $5,000 worth of Bitcoin. By using margin trading, you borrow $4,000 from the exchange. This means your total position is now $5,000, even though you only started with $1,000. The exchange will require you to keep a certain amount in your account as collateral. If your trade goes well, you can make a larger profit. But if the market moves against you, your losses can be much bigger, and you might even lose more than your initial investment. There are a few key points to remember about margin trading. First, you're using borrowed money, which means you're taking on more risk. Second, because you're trading with more than you actually have, your losses can exceed your initial investment. Third, exchanges usually charge interest or fees on the borrowed amount, so it's important to factor in these costs when planning your trades. Margin trading can be a powerful tool, but it's not without its dangers. Always be aware of the risks before you jump in. Now let's talk about leverage. Leverage is a measure of how much your position size is amplified compared to your actual invested capital. For example, if you have $1,000 and you trade $5,000 worth of Bitcoin, your leverage is 5x. This means your gains and losses are multiplied by 5. Leverage itself isn't about borrowing money, it's simply a ratio that shows how much you're amplifying your trades. Margin trading uses leverage, but not all leverage trading involves borrowing funds directly from an exchange. Let's break down the leverage formula. Leverage is calculated by dividing your total position size by your own capital. For example, if you have $1,000 and you take a $5,000 position, your leverage is $5,000 divided by $1,000, which equals 5x. This means every move in the market is multiplied by 5 for your account. It's a simple calculation, but it's crucial to understand because it directly impacts your potential profits and losses. It's important to note that leverage doesn't always mean you're borrowing money. In some cases, especially with derivatives like futures or options, you can use leverage without actually taking out a loan from the exchange. Instead, the platform allows you to control a larger position with a smaller amount of capital. This distinction is key for understanding how different trading products work and what risks you're taking on. Let's compare margin trading and leverage side by side. Margin trading is all about borrowing funds to increase your buying power. Leverage, on the other hand, is about amplifying your position size, whether or not you're actually borrowing money. Both allow you to take larger positions than your account balance would normally permit, but they work in slightly different ways. Understanding this distinction will help you choose the right trading strategy for your goals. Here's a quick comparison table to highlight the differences. Margin trading means borrowing funds to trade, while leverage is about amplifying your position. The risk with margin trading is high because you can lose more than your deposit. Leverage multiplies both gains and losses. Margin trading requires a margin account, while leverage can be used in margin trading or with derivatives. Margin trading usually comes with interest or fees, but leverage itself often doesn't have a direct cost. One of the biggest risks with margin trading is that your losses can exceed your initial deposit. If the market moves against your position, you might be required to add more funds to your account to avoid liquidation. If you can't, the exchange will close your position, potentially locking in a big loss. This is why it's so important to use margin trading carefully and always be aware of how much you could lose. Leverage can be a double-edged sword. While it can multiply your profits, it also multiplies your losses. Even a small move in the market can have a big impact on your account if you're using high leverage. That's why risk management is so important when trading with leverage. Always know your limits and set stop losses to protect your capital. To use margin trading, you'll need a margin account with your broker or exchange. This account is separate from a regular trading account and comes with its own set of rules. You'll have to meet minimum deposit requirements and agree to the terms set by the platform. Make sure you understand these requirements before you start trading on margin. When you borrow money to trade on margin, the exchange or broker will charge you interest or fees on the borrowed amount. These costs can add up quickly, especially if you hold your position for a long time. Always factor in these extra expenses when calculating your potential profits and losses. It's easy to overlook fees, but they can make a big difference in your trading results. Leverage isn't just for margin trading. Many derivative products like futures and options allow you to use leverage without directly borrowing money. In these cases, the platform lets you control a larger position with a smaller upfront investment. This can be a powerful way to trade, but it also comes with its own set of risks and rules. Let's look at how leverage can boost your profits. If you use 5x leverage and the price of Bitcoin goes up by 10%, your profit isn't just 10%, it's 50% of your original investment. This is because your position size is 5 times larger than your actual capital. Leverage can help you make bigger gains with less money, but remember, the same effect applies to losses. Just as leverage can multiply your profits, it can also multiply your losses. If the market moves against you by 10% and you're using 5x leverage, you'll lose 50% of your investment. This is why it's so important to use leverage carefully and always have a risk management plan in place. Let's walk through a real example. You have $1,000 and use 5x leverage to buy Bitcoin. If the price of Bitcoin goes up by 10%, your profit without leverage would be $100. But with 5x leverage, your profit jumps to $500. This shows how leverage can dramatically increase your returns when the market moves in your favor. Now let's see what happens if the market goes the other way. If Bitcoin drops by 10%, your loss without leverage would be $100, but with 5x leverage, your loss is $500. This is why leverage is risky. It magnifies both gains and losses. Always be prepared for both outcomes when using leverage. Because leverage and margin trading can lead to large losses, risk management is absolutely essential. This means setting stop-loss orders, only risking a small portion of your capital on each trade and never trading with money you can't afford to lose. Good risk management can help you stay in the game even if some trades don't go your way. Stop-loss order is a tool that automatically closes your position if the market moves against you by a certain amount. This helps limit your losses and protect your account from being wiped out. Always use stop-loss orders when trading with leverage or margin to manage your risk effectively. One of the golden rules of trading is to never risk more than you can afford to lose. This is especially true when using margin or leverage. The potential for large losses is real, so always trade with money you can afford to lose and avoid putting your financial security at risk. If you're new to margin trading or leverage, it's best to start small. Begin with lower amounts and lower leverage ratios until you're comfortable with how everything works. This way, you can learn the ropes without risking too much capital. As you gain experience, you can gradually increase your position sizes and leverage if you choose. Margin call happens when your account balance falls below the required maintenance margin. When this occurs, your broker will ask you to deposit more funds or close some positions to bring your account back up to the required level. If you don't act quickly, your positions may be liquidated automatically, resulting in losses. Liquidation is what happens when your account balance drops too low to support your open positions. The exchange will automatically close your trades to prevent further losses. This can happen very quickly in volatile markets, so always keep an eye on your margin levels and use stop losses to help avoid liquidation. When you hold margin positions for a long time, interest costs can add up. Even if your trade is profitable, high interest fees can eat into your gains. Always consider how long you plan to hold a position and factor in the cost of borrowing when making your trading decisions. Margin trading is available in both crypto and stock markets, but the rules and risks can be different. Crypto exchanges often offer higher leverage and lower margin requirements, but this also means higher risk. Stock brokers may have stricter rules and lower leverage limits. Always check the specific requirements of your platform before trading. Crypto derivatives like futures and perpetual swaps often offer very high leverage, sometimes up to 100x. While this can be tempting, it also means that even tiny price movements can wipe out your entire position. Use extreme caution when trading with high leverage in crypto markets. Besides interest, margin trading can come with other fees such as opening and closing fees or overnight funding charges. These fees vary by platform and can affect your overall profitability. Always read the fee schedule before you start trading to avoid surprises. Trading with leverage can be exciting, but it can also lead to emotional decision-making. The potential for big gains or losses can cause traders to act impulsively. It's important to stay disciplined, stick to your trading plan, and avoid letting emotions drive your decisions. Markets can be very volatile, especially in crypto. Margin trading in volatile markets increases your risk even more. Prices can swing rapidly, leading to quick gains or sudden losses. Always be prepared for volatility and adjust your leverage and position sizes accordingly. When you open a margin position, your broker will calculate a liquidation price. If the market hits this price, your position will be closed automatically to prevent further losses. Knowing your liquidation price helps you manage your risk and avoid unexpected losses. The maintenance margin is the minimum amount of equity you must keep in your margin account. If your balance falls below this level, you'll get a margin call. Always monitor your maintenance margin to avoid forced liquidation and keep your account in good standing. Position sizing is crucial when using leverage. The more leverage you use, the smaller your position size should be to manage risk. Proper position sizing helps you avoid large losses and keeps your trading account healthy over the long term. Margin trading also allows you to short sell, meaning you can profit from falling prices. When you short sell, you borrow an asset and sell it, hoping to buy it back at a lower price. This can be a useful strategy, but it comes with its own risks, especially if the price rises instead. Many derivative products, such as futures and options, offer built-in leverage. These products let you control large positions with a small amount of capital. However, they can be complex and risky, so make sure you understand how they work before trading. If your margin account falls below the required level and you don't add more funds, your broker will force liquidate your positions. This means your trades are closed automatically, often at a loss. Forced liquidation is a last resort to protect both you and the broker from further losses. Using high leverage can lead to account blowouts where your entire trading balance is wiped out by a single bad trade. This is why it's so important to use leverage responsibly and never risk your entire account on one position. Interest on borrowed funds in margin trading accumulates daily or even hourly, depending on the platform. Over time, these interest charges can become significant, especially if you hold positions for long periods. Always keep track of your interest costs to avoid surprises. Leverage makes your account more sensitive to market volatility. Even small price swings can have a big impact on your profits and losses. Always consider the volatility of the asset you're trading when deciding how much leverage to use. Holding margin positions overnight can be risky. Markets can move significantly while you're not watching, leading to unexpected losses or margin calls. If you plan to hold positions overnight, make sure you have enough margin and use stop losses to protect yourself. High leverage can lead to emotional trading where fear and greed drive your decisions. This often results in poor outcomes. The best traders stay calm and stick to their plans regardless of how much leverage they're using. When trading on margin, it's important to monitor your account regularly. Keep an eye on your margin levels, open positions, and any pending margin calls. Staying on top of your account helps you avoid surprises and manage your risk effectively. Trading with leverage requires discipline. Set clear rules for yourself such as maximum leverage, position size, and stop-loss levels. Following your rules helps you avoid big losses and keeps your trading consistent over time. Sum up, margin trading is about borrowing funds to trade larger positions, while leverage is about multiplying your position size to amplify gains and losses. Both tools can help you maximize profits, but they also increase your risk. Always trade responsibly, start small, use stop-losses, and never risk more than you can afford to lose. Understanding these concepts is the first step to becoming a smarter, safer trader. Thanks for watching. Now you know the key differences between margin trading and leverage and how to use them safely. Remember to always trade within your means and keep learning about risk management. Stay tuned for more tutorials on crypto and trading strategies. Happy trading!